Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to cover part 8 of our asset allocation series, and we're going to talk about investing in businesses passively. So in the prior video, part 7, we talked about actively investing in businesses, and that means when you go out and buy a business yourself or start a business from scratch, you are actively managing that business and you're involved in the day-to-day running of that business, and you are kind of the sole owner, with maybe a partner or two, owner of that business. So I want to be clear that that is the best way to build wealth. If you want to build wealth and achieve financial freedom early in life, you are going to have active management of a business. There's just no other way to do it efficiently, and that is the best way to build wealth quickly. So it's important, if you haven't watched part 7 of the asset allocation series, you need to check that out. Here in part 8, we're going to talk about passively investing in businesses. So you need to have, active management of a business at least at some point while you're in the wealth building phase, but you also need to start building passive streams of income. And a great way to do that once you've accumulated more wealth is to invest in businesses passively. I'm going to talk to you about how I like to do that through funds. And at the end of this video, I'm also going to share some thoughts on hedge funds. So hedge funds don't really involve investing in a business passively. It operates very differently, but I will share some thoughts on why I never invest in hedge funds at the end of this video. I do want to be clear that this video is not for everyone, especially if you're not someone who doesn't have, several millions of net worth already, or someone who could, is going to be in that situation very quickly. Then this video is probably not relevant to you. I'm going to share shortly in this video why I think the only good way to invest in businesses passively is through funds. And in order to get access to those funds, you need, or at least what I think of is quality deals and quality funds that I would personally be comfortable investing with. You're going to need to be at least a qualified purchaser or higher. So qualified purchaser means you have over 5 million of investable assets. And if you, aren't at that level, don't see yourself ever being at that level, or aren't close to it, then you might want to, skip this video. It might not be relevant for everyone. So just as a quick reminder, we are talking about, how to allocate your money across the different asset classes. And we're in part 8 where we're going to talk about these 3. So private equity and venture capital are, those are types of businesses or ways to invest in businesses. And I'm going to dive into those in a little bit more detail. And then at the end, I'm also going to share some thoughts on hedge funds, which are not really investing in businesses, but just, usually we think of these 3 together. If you're not very familiar, I'm not going to tell you about what a private equity fund is or what private equity, venture capital, and hedge fund means and what, how they're different. If you want to, understand that better and don't know that, I'll link below to my video where I do a walkthrough of those 3 types of funds and how, what each is and how they're different. It's important you understand that before you invest in it. You've got to know, as Warren Buffett says, you've got to know what you're investing in. So I'll link to that below. If you aren't familiar with the differences in these 3 types of funds, check out that video before you watch this and then come back and watch this one. So let's just talk quickly about the methods for investing. And again, here, I just want to reiterate, we are talking about investing passively in businesses. So I'm not talking about, you go out, or you and a friend or, a partner or two go out and buy a business and manage it yourself. I'm talking about you're going to be hands off. You're not going to really be involved at all in the day to day, but you still want to be invested in businesses. So we all know we can just go out in the stock market and buy shares in public companies. I'm going to carve that out. I've talked about that in, in other videos, especially in earlier in this asset allocation series, but I'm not talking about that. But of course I do know, yes, you could own a tiny percentage of a public company by going out and buying shares in the stock market. So let's carve that out for now. We're not talking about that. So the different methods that, you could invest, you could do friends and family. So that is really just any opportunity that comes through your network. I've gotten this a lot, in my life. It's a buddy, a friend of a friend, has a new company and wants to talk to me about, if I would be interested in investing in that. I turn those down. Blanket no, unless, your cousin Jeff Bezos or, Uncle Elon Musk or something is coming to you. I personally am very anti friends and family investing in anything, whether it's real estate, a fund or just a new business venture. I just don't do it. When I've seen people go really badly, it's they've either just used a really, sleazy or really bad sponsor, or, they're investing with a friend, and that can get awkward, right? There's all kinds of dynamics when it's through your network. It's just a very different, I don't touch it. I don't like it. And they usually don't turn out well. And it's hard to be, to really do due diligence fairly and objectively when it's someone you know or a friend of a friend or something like that. So I don't do friends and family. Yes, the people who got in early on Amazon because they were friends or family of Jeff Bezos, yeah, they made big, but that's, to me, that's 1 in a million or even maybe worse odds. But I just don't do it. I'm not going to tell you not to do it. You need to make your own decisions, but I would just, tread very cautiously there. People also think of investing in private businesses by lending money. So it might be, the same friend comes to you or, and says, I want to start a business. Can you give me a loan? I don't consider that investing in the business. That's really debt. Right. So you're not, unless there's some sort of equity kicker in the loan, or way that the loan can, and that can happen actually, especially with the way some startup investments are structured. But I want to be clear that when someone asks you to lend them money to start a business and you're not getting ownership interest in that company, that is not investing in the business. That is investing in debt, right? Because they're going to pay you interest for that. And, hopefully you get the loan repaid at some point if the business does do well. So that is not what we're talking about here. That's just not investing in businesses. That's investing in debt. And I generally don't like that in the first place, but I just want to carve that out. A few other, especially for people who are not quite, at that qualified purchaser level and like to invest in private equity and venture capital. And, they think, let me get into the new Airbnb or something. Crowdfunding has become very popular because it does give access to everybody. While I'm a big fan of everybody having the right to invest in these things, I don't like the SEC regulations around this where they just assume because you don't have, a certain amount of wealth or money that you aren't smart enough to assess the deal. I think that's I have a lot of issues with that for a number of reasons. But the unfortunate reality of that is that quality sponsors are not going to people who aren't qualified purchasers with their PE funds, with their venture capital funds. Even if they could do something, even if someone theoretically could do something through a crowdfunding website, and these are all online platforms, the most popular is Fundrise. They do real estate, but, they do have some private equity deals in there as well, or some, venture capital type deals. I stay away from those. In my experience, quality sponsors, quality deals are not showing up on that platform. I could talk all day about why that is because I know, the fun side of it and why they, if you are good at what you do, you're not going to be on those platforms raising money. But just, in my experience, I would just run away from those. It's just never where I would invest my money. So, while it may be very intriguing if you're not able, because you're not a qualified purchaser, to be able to get into some of those deals, or with accredited investors, getting into some of those real estate deals earlier than you would be able to because you're not quite at the required threshold. Just, think about why that's available. And because it's like, when you think about clothes on sale, those are clothes nobody wanted, so think about it that way. And I would just tread very carefully with that. I would never invest through Fundrise. I don't know anyone who would that really understands this stuff and what they're doing. So, kind of similar to that, there is this new kind of secondary market popping up for pre-IPO shares. So pre-IPO just means right before the company goes public. So think about, if you could have bought in to like Airbnb or Uber right before it went public and, became tradable on the stock market where everybody could invest, then, I don't know what happened, how much those shares took off once they came listed, but, sometimes those are great deals you can get. I've done pre-IPO investing in the past. I'll talk a little bit about that more when we get down to how I do that. But, I'm not a fan of the secondary markets for a number of reasons. There's things like Equities In is the one I'm most familiar with. There's others that are, competitors to that. But that is what's basically happening is a lot of times it's insiders, like maybe it's a employee at the company, for example. They want to sell their shares on the secondary market. So they got the shares maybe for working at the startup, and they can list those shares on Equities In. And there's a lot of nuances to how it works that you would have to learn before you did it. You've kind of got to put an order in for what you want. And you have to see, if there's anybody who wants to offer their shares up, which, if it's a really good company, why is anybody offering their shares? So there's a lot of issues there, but I just want to talk about it because they are becoming very popular. I would try very cautiously. I'm familiar with these platforms. I sometimes go to these platforms just because I'm curious about some of the data available to me on the platform and what's going on with the pricing in the secondary market, but I've never invested. I never would invest through that type of market. And so, yes, they are becoming very popular. And yeah, it sounds great to be able to maybe I can invest in the next, big popular company, but that's not always great deals. And if it is a great deal, why is it available to you? That's kind of the way to think about it with a lot of these deals. Before a company goes public, or before a company gets really big. It's just about access. It's how can I get access to the great deals, because I'm an everyday Jane. We're not, I'm not best friends with Jeff Bezos or someone like him, at least to my knowledge at this point. So, I'm not getting those friends and family deals. And, nobody is really, right? Unless you're just very lucky to kind of hit the lottery with some of that stuff. So how can I get access to good quality deals? And it's not through crowdfunding platforms. It's not through secondary markets like Equities In. It is, in my opinion, through funds. So the only way someone like me can really get access to a really good quality investment in private equity and venture capital has been through funds. So that's, very similar to like a real estate fund. You invest through a fund that is going to go out and buy private equity, invest in private equity companies. So like they're going to buy portfolio companies. It might be, 5 companies that the private equity fund manages, or it might be, 20 or hundreds. I've been all across the range of that. Same with venture capital. So, venture capital funds go out and invest, in venture capital. And so just a reminder, if just to refresh our memories, venture capital, think like startup, early stage companies. So a lot of them, might be, think Uber when it was very new, it was very early and, you probably hadn't heard of it, or it might be beta testing the app. Those are very early stage companies. So they might be a little bit risky because a lot of them will fail, right? Private equity is what I think of as much later stage companies. So those companies are usually much larger. They're usually more proven, and they're just not public, right? They're not available on the stock market. So some of the companies you may have heard of, but it's just going to be the largest companies that aren't publicly traded. Some of them will eventually be publicly traded at some point. Venture capital, the goal is almost always to list. So like, with venture capital, you're trying to get in there early to like Uber before anybody's ever heard of it, get shares. And then once Uber goes public and lists, you sell your shares and you've made a fortune. So that's venture capital. Private equity is more, usually you're investing higher percentages. So a private equity fund might own 20%, 30% of a company. They might even put someone on the board to help manage it. So private equity is very different than venture capital, but you can still invest through funds. So yes, you do need to usually be a qualified purchaser. That means over 5 million in assets, not counting things like, your home, which is not an asset, but, 500 million of investments or investable assets. And then you can get access to good quality investments like private equity funds or venture capital funds. One other point I don't want to talk, because this can get very complicated, especially with venture capital, a lot of it might be fund of funds. So again, remember, it's all about access. It's all about how can I get access to good deals that aren't otherwise available to me, just the average everyday investor, without paying some crazy fee or paying, way over market for the shares, themselves. So with venture capital, I have found that a lot of the investments that are available to me, a lot of these funds are very large and they don't care about me. They don't want to deal with me. So they'll aggregate by there might be like a really big venture capital fund. And then you might have smaller funds that are coming in and investing in that big fund. So that's fund to funds, right? So, I invest in fund A, and then fund A goes out and invests in, venture capital fund 1, 2, 3, 4, and 5. So it's fund to funds or different layers of funds. And yes, that adds more fees. So you've got to balance, you got to look at the fees you're paying with, the access to the deals and, the risk you're undertaking. Yes, I agree. Venture capital can be risky to some extent. I personally think about risk very differently than I think a lot of people there are a lot of people who just don't touch the space, but I invest a lot in venture capital fund of funds. And just again, I can't reiterate this enough when it comes to investing in funds like private equity funds and venture capital funds and even hedge funds to some extent. It's going to be about how can I get access to those deals, because they usually go out and are available. If I was Jeff Bezos and I was a billionaire, if I had hundreds of millions of dollars of net worth, there would be people coming to me wanting me to write a check. But, big private equity funds don't care about my, $250,000 investments. That's so low to them. So you have to aggregate all these $250,000 investments with other investors and go in together to the fund and to buy these companies and that type of thing. So that's how to think about it. You're really looking at access and balancing risk and funds and return potential when at the end of the day with this stuff. So I want to talk about why I, invest through funds. Like why in this space, when it comes to private equity and venture capital, do I like the approach of going through funds? So as I kind of talked a good bit about this, and I know I sound a bit repetitive, but what's really important here is deal access, and how can you get the ability to invest in the best quality deals? That is through a fund. Again, I'm not rich enough to be able to write $10 million checks, $20 million checks for one investment in a fund. I'm doing, more like 100,000, 250,000, sometimes higher, depending on the deal and, what I think about it. But it's just my ability to get access to those great deals without being a uber, billionaire. So that's really all it is at the end of the day. The large return potential. So with private equity and especially venture capital, there is no ceiling on the amount that you can earn on investments. So for example, these are the deals where I make the most money. So yeah, people might tell you venture capital is the most risky. People may say, I don't personally think if you know what you're doing on the due diligence side with private equity and picking good sponsors to invest with, I don't think it's super risky in my opinion. I actually think it's one of my safer investments. I mean, I don't make investments I don't think are safe, but the large return potential, you should be looking at returns well above 20%. If you're not getting 20% plus on these investments on average, from these funds, then I would consider that a bad investment. So there's really large return potential. Some people may say you're taking on more risk to balance that, but again, it's all about how you think about risk and what you're doing. Diversification. So, instead of me going out on EquityZen, for example, and buying shares in random company that hopefully will go public, in a couple of months or a couple of years, I can, through a fund, own multiple companies. So if it's venture capital, you might be invested in 50 companies where, 20 of them fail, but 30 of them do succeed, and you need like one or two that are just, take off. I mean, that's kind of the way venture capital works. You're going to have some losers there, but all you need is one or two to really take off. And that can just be massive returns that you never imagined. So I like the diversification. Same with private equity. Good private equity funds are very large. The ones I'm invested in, they are invested across all sectors. They are, invested in tons of different companies. And so I like the diversification there. Again, remember we have layer one, diversification, which is allocating across the asset classes. Layer two is allocating within that asset class. So within private equity, I'm investing in a lot, like every industry you could imagine, all different types of companies located all throughout the world. So I like that because the fund just does the diversification for me because you're investing in a lot of different companies. Transparency. So I'm going to talk a little bit about the negatives of this with hedge funds. And one of the many reasons I don't like hedge funds is that you don't really know what you're investing in. But with private equity, especially in venture capital, you know what you're invested in. You might not know before that investment is made because of, there are some confidentiality issues there because these deals are very large, but you're going to know, you're going to get good report. If you're investing with a good sponsor, you're going to get reporting on that. And you're going to know exactly what you're invested in. You're going to know how those companies are doing, what those companies do. And, you should be able to see, what exactly you own at the end of the day. I also, I only make long-term investments. So private equity and venture capital, I personally, the best assets are the ones you can own for life. But I do think, just practically speaking, you do have to own some assets that at some point are going to have to be sold. So, I like that private equity and venture capital funds have a very long-term horizon. So private equity, for example, you're thinking 5 to 10 years minimum. Usually sometimes they go longer. Venture capital can be the same. It just depends on when you're investing in the, in the cycle of the underlying companies. You're going to have sales, here and there. So, if you get in a private equity company starting year 5, you're going to have some sales. It doesn't have to be year 5. It's just whenever the fund managers think, that portfolio company should be disposed of, or, venture capital. When it's the time, you're not going to have any, control over that. It's whatever the fund manager thinks. But once you get later on into the fund, the term of the fund, you're going to start having some sales. So you are going to have, some capital gain if it's a private equity fund. But with venture capital, so this is what I really like about venture capital. So private equity funds, you are going to have some capital gains when those sales are made. They're, unless you need to do tax planning outside of that to reduce that, you're not going to be able to really reduce the capital gain itself because you have no control. So there is some tax leakage there. Why am I hate paying taxes, right? So why am I okay with tax leakages when it comes to private equity? That is because the returns are so high that the after-tax return is still worth it to me. I mean, after-tax returns are still above 20%. And the other thing is that I'm able to do tax planning out here that can offset that capital gain as well. In most cases, sometimes you're just going to have such a big, gain that there's nothing you can do about that. And again, I don't care, right? So if I've got to pay a little bit of tax on, some massive investment that, returns me a bunch of money, that's great. Like I'm happy to pay that tax because it means that I did really well. So you are going to have some tax leakage at some point, and that's usually a good sign that the fund's healthy. So you got to be doing tax planning outside of that to be prepared for those capital gains you're going to get. Because you don't want to, if you can reduce that, you do want to. With venture capital, because of 1202 qualified small business stock exclusion, I'll link to that video below, where I talk about that. But you, in most cases, can avoid capital gains on, most sales through venture capital funds. And that is because hopefully the fund is investing pretty early in the stage of the underlying company. Sometimes you're not going to be able to because of various reasons and nuances. And sometimes the venture capital fund doesn't come in until, later, until the company's too large to qualify. But if the underlying company, if you're investing through a fund, even if it's a fund of fund, you should, if that underlying company that sold qualifies for 1202 and your investment qualifies for 1202, you should not have to pay tax on up to 10 million of the gain. So, unless you're just making massive and, writing really large checks for these venture capital funds, or the thing just skyrockets to the point that you're making over 10 million gain on it, you probably can avoid tax on most of your investments in a venture capital fund. So that's a big reason I also like venture capital, is you can really have like a really successful fund where you're making really high returns on a lot of different underlying portfolio companies and avoid paying any tax because of the 1202 qualified small business stock exclusion. So check out that video. That's really important. Your fund managers are not going to know about 1202. A lot of their tax professionals don't even know about it, the people that prepare that. So sometimes you might have to push back and ask them questions about it. I've certainly had to do that in the past, but that's definitely something you need to know about yourself if you're going to be a VC investor. So let's talk a little bit about how much we should allocate to private equity and venture capital. So as I've talked about before, if you are not an accredited investor or not a qualified purchaser, so, if you're at either one of these stages but not yet a qualified purchaser, I wouldn't be investing in these spaces. I just don't think that, in my opinion, you're going to get good access to good deals. So I wouldn't do it. That's just my own opinion. If you are a qualified purchaser, I like these spaces a lot, especially private equity. You can decide between this. I would lean heavier. If I were doing 25 to 35%, I would be much heavier on the private equity side than venture capital. But I'm a big fan of this space. I have a large portion of my portfolio dedicated to private equity funds and, a decent size dedicated to venture capital. So I'm a big fan of these spaces, as you can see, and what, I allocate and my thoughts on allocation. When you get within those, so I try to, as a good rule of thumb, I don't like too much money with one sponsor. So I try to keep less than 5% with any, one sponsor. So I think, I think about that as a factor of my net worth. So you can think about it, as a factor of the 25%, however you want to think about it. But I never want over 5% of my net worth or over 5% of my private equity investments with just one sponsor. Same with venture capital. So I like to diversify within the private equity fund and venture capital fund as well. You don't want to just put 25% of, all your money you're going to allocate to one private equity fund. You want to try to break that up with across a couple of good sponsors. That's my opinion. I know there's people who disagree with that. And, I know there's some people who don't think diversification is all that great when it comes to stuff like that. And if you find a good investment, just stick with it. I can see the pros and cons to it, but I personally don't like to have too much money with any one person. That's just how I feel. I just can never fully trust someone unless it's me, unless it's my own personal business that I'm running and I can manage everything, then I'm always a little hesitant to have too much of my net worth with one person. So there's thoughts on that. Again, I'm sorry if you're not at the qualified purchaser stage. I know it's bad news for you at this point, but I do think once you get to that stage or once you get close to that stage, you need to start thinking about finding good sponsors to invest with. I have a course where I talk about how I find deal flow, for these investments. It includes real estate investments, private equity, venture capital. It's the same channel for all different types of funds. So I'll link to that below. If you are at this qualified purchaser stage or very close and you're interested in how I approach that and how, I access those types of investments, then check out that course. It's a great way to see, how I think about that. So I get asked that question a lot. How do I find, sponsors to invest with? So I share in that course my due diligence process and where I go to look for those types of investments. Okay, so I just want to end with sharing a few thoughts on hedge funds. So I know the purpose of this video is investing in businesses passively. That is private equity and venture capital, but hedge funds are not really investing in businesses, so to speak. They can be, but it's a lot of different types of, investments through a hedge fund. But I did want to talk about them because you always think about private equity, venture capital, and hedge funds in the same, you always kind of couple those three together. So I'm just, I'll be straight about the fact that I don't like hedge funds. I think they can be very sexy investments to make. I think people think it's cool to say, I'm invested in a hedge fund or I work at a hedge fund. It's always been kind of, thought to be like the cool space to work in. I think, I was in my prior life advising private equity funds, venture capital funds, and hedge funds. And, the hedge fund space is very different. I found a lot of the people that we worked with in that space weren't very nice to us. And it just was never a good environment in my opinion. That was my experience. But so that's one of the many reasons I don't invest in hedge funds, but just, what do hedge funds own? So again, check out that video where I talk about hedge funds, venture capital funds, and private equity funds and explain what those are if you don't know. But hedge funds just own anything. Like they'll just own absolutely anything you can imagine. If it's an asset or investment, they will invest in it usually. So stocks, bonds, commodities, currencies, derivatives, REITs, real estate, really anything across the board. And you might have a hedge fund that owns all of these things. You might have a hedge fund that has, a specific type of strategy where, maybe they try to short the stock market because they think there's going to be a recession or something. So there may be like a shorting strategy. They may also own some bonds. It's a lot of crap. I think, a lot of crap that hedge funds own. And you don't generally, you should have a sense of what the strategy is, before you invest from the manager. But, you're not going to really, as you're owning it or before you own it, you're not going to have any clue really what exactly you're investing in. So that's one of the many reasons I don't like it. So just really quickly to finish this off, why don't I like hedge funds? They're highly speculative. So they're really just kind of making bets, in my opinion. A lot of hedge funds are making a bet that the market's going to go down. So they're going to start doing a shorting strategy, for example. I don't invest that way. No one who I value their opinion on investing, from Warren Buffett to, anyone you can think about that I think is just like historically the best investors out there to take advice from. They're not into speculating, right? They're also not into short-term investing. So I think hedge funds, pretty much every hedge fund I've ever been aware of and seen, I think is way too short-term focused. They'll turn investments. The turnover will be really quickly on a lot of things. You can talk about all kinds of income coming from it. It's a lot of short-term capital gains. It's a lot of interest income depending on what they're investing in, currency gains. It's very tax inefficient for a number of reasons, because of the type of income you're getting, as well as, the classification, for example, the holding period. So with stocks, at least if you're going to sell those, you want to hold those for a year if you can and get long-term capital gains treatment and pay lower tax. But with whatever hedge funds are just churning out, they're going to, kick off a lot of things like short-term capital gains. I've mentioned this before, there's a big lack of transparency in investments that hedge funds own. You really have no clue. And based on historical performance, hedge funds rarely outperform the market in the long run. This has been talked about to death. I'm not going to, drag out too long about this. Warren Buffett has talked about this. These professional hedge fund managers, might sound great and stuff on paper for a couple of years. They might look good. They might, have great returns. But then the next year, they might really underperform the market. So on a long-term basis, they rarely consistently outperform the market. They have all these sophisticated strategies. To me, it's too complicated. I'm just a meat and potatoes kind of girl. I'm just very common sense when it comes to investing. And hedge funds just go the complete opposite way of that. They, I think, overcomplicate things. And I think it's just extremely, highly speculative. If you are going to invest in hedge funds, one time somebody gave the advice that you better buckle your seatbelt because it is the craziest, most volatile thing probably that exists. You may have, you may be up 200% one year and you may be down 300% the next year. And that changes very quickly. You can have extreme swings even within, the span of a week or two. So, I'm not someone who really cares a lot about volatility, but I'm looking at volatility in the long run. So the stock market, I don't care if it goes down. I don't care what it goes down to tomorrow because I don't care. I'm not selling my stocks and it just doesn't matter. What I care about is what is the stock market 50 years from now? And based on history, it is going to be significantly higher. That's just the way it's been. Hedge funds, that's not the case, right? So in the long run, when we look long-term, because we think about investing long-term, it's a long game. Hedge funds rarely outperform the market. So why am I stomaching that crazy short-term volatility when, I'm looking at long-term volatility, and I'm looking at long-term returns, and they're not outperforming the market. So that's my thoughts on hedge funds. I don't invest in them. I know a lot of people would disagree with me. I know a lot of people, are big fans of hedge funds. They're also, hedge funds you're not going to be able to invest in a good quality hedge fund if you're not at least a qualified purchaser. In a lot of cases, hedge funds are going to have minimums of $1 million or higher. So even if you are at that qualified purchaser level, it might mean you're probably not going to get access to good quality hedge funds. Those are really more for people who are, what I described before, like the $100 million, $200 million type uber wealthy people. And, again, even if I was at that point, I wouldn't be making those investments because I just don't think it's a great investment strategy. But, they're not interested in people like me. And it's really difficult, even, until you have significant, uber amounts of net worth to really even get access to a lot of these deals. So that was part 8 of our asset allocation series, where we talked about investing in businesses passively with some thoughts on hedge funds and why I never invest in hedge funds. So hopefully you found this helpful. In the next video installation, we're going to cover part 9, which is going to be one of my favorite new asset classes, which is cryptocurrency.